Good morning, everyone. So I would like to discuss the recent November 2020 question paper of SFM Strategic Financial Management. Okay, let me proceed with the first question. Now we'll discuss one by one. The entire question paper will give the suggested answers. We'll start one by one. Okay, right. Look at the first problem. This problem is relating to Chapter 9, Foreign Exchange Exposure and Risk Management. Let me read this problem. ZX Limited has made purchases worth $80,000 on 1st May 2020, for which it has to make a payment on 1st November 2020. The present exchange rate is INR by USD 75. The company can purchase forward dollars at INR by USD 74. The company will have to make an upfront premium at the rate 1% of the forward amount purchased. The cost of funds to ZX Limited is 10% per annum. The company can hedge its position with the following expected rate of USD in foreign exchange market on 1st May 2020. Expected exchange rates. INR by USD 77, 71, 79, 74 and the respective probabilities. Okay, right. You are required to advise the company for a suitable cover of risk. So cover for risk, nothing but hedging the risk. Cover for risk is nothing but hedging the risk. Okay, very simple. Hedging the risk, simple plain framework. Before proceeding this problem, we'll discuss about small framework, which is applicable to all types of hedgings. Framework for hedging strategies. Very simple. It's a plain logic. It's not technical kind of thing. Framework for determination of hedging. Framework for deciding upon hedging. Framework for deciding upon hedging. That means whether to hedge or not. So whether to hedge or not. Whether to hedge or not is the first question. So the question addressed by this problem is whether to hedge or not. Okay. So not which hedging strategy be applied, whether to hedge or not. Whether to hedge or not. Okay. Right. So very simple plain strategy. In case of payments, if the hedging strategy results in less payments, hedging is preferable. In case of receivables, if the hedging strategy results in more receipts, then hedging is preferable. Okay, right. Look at this. So we'll take 2 points: payments and payables and receivables. Payables and receivables. Payables, receivables. Right. So hedging strategy is preferable. When hedging strategy is preferable, when the payments is less. When the payments is less, hedging strategy is preferable. Hedging is preferable. Okay, right. Hedging is preferable. When hedging is preferable, when the payments with hedging. Okay, payments with hedging are less than expected payments without hedging. Payments with hedging are less than the expected payments without hedging, then hedging is preferable. Okay, less payments, hedging is preferable. Hedging is preferable because of less payments. Okay, so therefore what? Hedging is preferable. As less payments, hedging is preferable. Less payments, hedging is preferable. Less payments, hedging is preferable. Okay, right. In a similar manner here, receipts. Okay, receipts with hedging is more than expected receipts without hedging. Expected receipts without hedging. Okay, expected receipts without hedging. So more receipts, hedging is preferable. It appears to be very simple, but it should be drawn before solving the problem. Next. So it is like this. Next, hedging is not preferable. When the hedging is not preferable, when the opposite is true. Okay, hedging is not preferable. When the opposite is true. Payments. When the payments with hedging, is more than expected payments without hedging. Therefore, more payments hedging is not preferable. More payments hedging is not preferable. More payments hedging is not preferable. Okay, right. Next, here receipts with hedging is less. Receipts with hedging is less. So less receipts hedging is not preferable. Less receipts hedging is not preferable. Okay, right. Less receipts hedging is not preferable. Okay, as simple as that. So in case of payments, it is less payments hedging is preferable, more payments hedging is not preferable. In case of receipts, more receipts hedging is preferable, less receipts hedging is not preferable. It's a plain simple concept, but it should be drawn before solving the problem. We have to look upon whether it is a receivables or payables. So therefore here we have purchased the goods. Here in this question, ZX Limited has purchased the goods. ZX Limited has purchased the goods. ZX Limited purchased the goods. Therefore, payment. It has to make a payment. To make a payment. So therefore, it is a payable. So since it is a payable, for the time being, we'll ignore this. We'll focus only on this. So we'll have to calculate payments with hedging and expected payments without hedging. Based on that, we'll decide whether to go for the hedging or not. Right. So payments with hedging. So what are the hedging strategies? There are many hedging strategies to be used. Forwards, futures, options, swaps, etc. But given the information, they have given information only related to the forward contracts. Okay, so therefore we can think about only forward contract. It is not that the forward contract is the only method of hedging. There are many methods of hedging, but the information is given only related to the forward contract. Okay, so therefore we'll go for the forward contract hedging. Okay, right. Next. Look at this. The present exchange rate is INR by USD 75. The company can purchase forward dollars at INR by USD 74. The company will have to make an upfront premium at the rate 1% of the forward amount purchased. This is what we have to understand. So what is the reason for this premium? What is the reason for this premium? What is the reason for this premium? Why this premium is charged? Here there are two costs of hedging. There are two costs involved in hedging. Cost to enter the contract and cost to perform the contract. Two costs are involved in hedging. First point, cost for hedging. Costs involved for hedging. Costs involved for hedging. There are different costs are involved. First cost is cost to enter the contract. 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 And next cost to perform the contract. Cost to perform the contract. So this is nothing but premium. This is nothing but premium. This is nothing but premium at the rate 1%. This is nothing but premium at the rate 1%. This is nothing but INR by USD 74. INR by USD 74. This is cost to perform the contract. Now we have to discuss about the reason for the premium. Why the premium is charged? Normally the premium is charged for the options contract, not for the forward contracts, right? But here, even though it is a forward contract is given, but still they are talking about the premium. Forward contract information is related to forward contract, but they are talking about the premium. So therefore you have to think about why the premium for forward contract. The reason is that we are dealing with currency forwards, not financial forwards or commodity forwards. So currency forwards are governed by the Foreign Exchange Management Act, and there is a separate rules. Foreign exchange management, foreign exchange derivative contracts rules 2000. There is a separate rules. Okay, so legislative framework. So these are the 2 points. Next, if we discuss the reason for premium, legislative framework for currency derivatives, legislative framework for currency forwards, legislative framework for currency forwards. So first point, Foreign Exchange Management Act 1999 is the first point applicable. Okay, Foreign Exchange Management Act 1999, and one more point is there. Within that there are rules. Foreign Exchange Management, Foreign Exchange Management, Foreign Exchange Management, Foreign Exchange derivative contracts, Foreign Exchange derivative. Foreign Exchange Derivative Contracts Rules 2000. Okay, right. This is the point. Foreign Exchange Derivative Contracts Rules 2000. Okay, I think regulations. If I'm not wrong, regulations. Okay, right. Foreign exchange derivative contracts regulations 2000. Okay, regulations 2000. Right. So as per this Foreign Exchange Management Act and Foreign Exchange derivative contracts regulations 2000, you can enter a foreign exchange forward contract only with an authorized person, that is to say bankers, not with anybody. So you can't enter a forward contract with me, or I can't enter a forward contract with you. In currency forwards, in currencies, forward contracts cannot be entered between any persons. In currencies, forward contracts can be entered only with the bankers, persons authorized under the Foreign Exchange Management Act. Right. If that is the case, banker bears the counterparty risk. The reason for charging the premium is here ZX Limited. Okay, ZX Limited and the other counterparty is authorized person under FEMA. Okay, authorized person under FEMA. So that is example bankers. Okay. So now the reason for the premium is that for the ZX Limited, okay, no counterparty risk. Counterparty risk refers the risk arising from default on the part of the other party. Okay, counterparty risk refers the risk arising from the default of one of the party to the contract. Okay. In the given case, there is no counterparty risk to the ZX Limited because the counterparty is a authorized banker. So therefore, there is no counterparty risk to the ZX Limited. Okay, right. So counterparty risk refers to risk arising due to default of the other party to the contract. In the given case, there will be no counterparty risk. To ZX Limited. As the other party is the banker. But there will be a count. But the banker will have counterparty risk. But the banker will have counterparty risk of ZX Limited being defaulted. There is a chances that ZX Limited may not perform the contract. No doubt, today they have entered into a forward contract. They are giving a commitment. It is not necessary that everybody will fulfill their commitments. If everybody fulfills their commitments, there is no question of courts and all these disputes. These disputes arises only because people are not fulfilling their commitments. No doubt, ZX Limited is signing a contract on black and white. They are signing a contract and they are giving a written commitment. But there is no guarantee that you stick on to your words, you stick on to your commitments. Therefore, there is a chances that ZX Limited may default. ZX Limited may not perform the contract. Since the banker is bearing the counterparty risk, banker is charging the premium. So banker will have counterparty risk of ZX Limited being defaulted. So in order to compensate that counterparty risk, banker will charge premium. That is what the point. In order to compensate that counterparty risk, banker will charge the premium. That is what the point. Okay, right. Now, therefore, that is the reason for the forward premium, because of counterparty default, because of counterparty risk. Okay, right. Now, so the reason for the forward premium is this point. The reason for the forward premium is banker is facing the counterparty risk. Anybody who is bearing the risk is entitled for premium. ZX Limited is not entitled for any premium for the banker because he was not taking any counterparty risk. So only those who are bearing the risk is entitled for the premium amount. In case of options contract, option writer is facing the risk. So therefore, he is entitled for the premium. Option holder is not facing any risk. Therefore, he is not entitled for the premium. Anybody in the free capital competitive markets, anybody who is bearing the risk is entitled for the premium, has a right to command a premium for the other party to compensate the risk taken. Okay. So therefore, since the banker is bearing the counterparty risk, banker will charge the premium from the ZX Limited. But ZX Limited is not bearing any counterparty risk. Therefore, ZX Limited will not charge any premium. We cannot charge any premium from the banker. That is what the point. Next, right. Next, that is what the point. So therefore, that is the reason for the forward premium. Next, we'll calculate what is the cost of the forward premium. Look at this. So some of the students are making mistake here in calculating the forward premium. In calculating the forward premium, some of the students are making mistake. Look at this, US dollars 80,000. So premium is paid on what? Upfront premium 1%. Okay, no doubt. I am paying the premium, was fine. On what? I am paying the premium on what? Premium of the amount purchased. Premium of the amount purchased, not the money paid. Not the money paid. Okay, premium of the amount purchased. Here, if you look at this point, ZX Limited. ZX Limited authorized person. So ZX Limited is taking, ZX Limited is purchasing 80,000 USD. Purchasing 80,000 USD from the authorized person. And on that they will pay 74 rupees. On that they will pay 74 rupees. What is the 74 rupees? 80,000 into 74. 80,000 into 74. How much it is? 59 lakhs 20,000. 59 lakhs 20,000. 59 lakhs 20,000 is the rupees. 59 lakhs 20,000 is the rupees. Here this 1%, 1% is to be charged on this, on 80,000, not on this 59,200. This is not correct. Some of the students are making mistake here. They are calculating 1% on this. That is wrong. Why it is wrong? Be clear about the concept. So here we are talking about the purchased. Okay, ma, we are talking about purchased. So this is the purchased amount purchased. This is the amount purchased. Okay, this is the amount paid for the purchase. This is the payment made for the purchase. This is the payment made for the purchase. That be clear. Amount purchased is $80,000. Payment made for the purchase is payment made for the purchase. So therefore that 1% has to be calculated on 80,000, not on 59 lakhs 20,000. That means forward premium has to be paid in dollars. Now in this problem, forward premium amount is paid not in rupees but in dollars. Okay, that is the point. So 1% of the amount purchased. So therefore the first point, cost of forward premium. Okay, the first point, forward premium. The first point. So look at this. So this is the two mistakes people are doing. So the correct answer is 80,000. 80,000 into 1%. 80,000 into 1%. It will be $800. It will be $800. 80,000 into 1%. It will be $800. Okay, it will be $800. Right. So it will be 800. What is the current exchange rate when we have to pay the premium? This forward premium has to be paid upfront. This forward premium has to be paid upfront. That means today. That forward premium has to be paid upfront. That is today. That is at 75 rupees. At 75 rupees. INR by 70. I have to pay $800 to the banker, but I don't have $800. So therefore, I have to purchase 70. I have to convert into at 75. So therefore, the commission will be upfront commission will be 60,000. This is the correct answer. Upfront commission will be 60,000. This is the correct answer. Okay. Upfront premium will be 60,000 rupees. Upfront premium will be 60,000 rupees. So upfront premium will be 60,000 rupees. This is the correct calculation. This is the correct calculation. Now I'll show you what is the wrong calculation. I'll show you what is the wrong calculation. Wrong calculation done by most of the students is this 80,000. This 80,000. They will take 80,000 into 74. 80,000 into 74. This will be 59 lakhs 20,000 rupees. This will be 59 lakhs 20,000 rupees. This will be 59 lakhs 20,000 rupees on that 1%. On that 1%. On that 1%. Will be 59,200. Will be 59,200. This is the wrong answer. This is the wrong answer. Because that we are paying on amount paid, not on amount purchased. So therefore, this is what the point. So this is the amount purchased. This 80,000 is the amount purchased. Okay, ma? That 80,000 is the amount purchased. This is the 80,000 is the amount purchased. This is the 80,000 is the amount purchased. Now this is the money paid. This is the money paid. This is the money paid for the amount purchased. So therefore, it is not appropriate to apply 1% on this 59 lakh 20,000. We have to apply 1% on this 80,000. Okay, amount purchased is 80,000. Okay, right. So therefore, this is the wrong answer. What we have done, this is a wrong answer. Okay, so maybe that one of the possible mistake in the exam. It should be clear. Okay, therefore, I'm explaining the reason why that is wrong, because they are talking about the amount purchased and you have done about the money paid. Therefore, this is the wrong answer. This is the wrong answer. Therefore, upfront premium is 60,000. Upfront premium is 60,000. But from where you'll get the 60,000? We have to borrow money. We have to borrow money. Or even if we have a surplus cash with us, if we don't need to borrow, but we'll lose that opportunity cost on borrowing. This 10%, either you can take it as a opportunity cost of funds, or you can take it as a cost of borrowing. The cost of funds to ZX Limited is 10% per annum. So therefore, what is happening now? Therefore, what is happening now? Look at this. So I'll give the timing limit. I'll give the time limits. Okay, right. Look at this. What is happening today? What is the date today? 1st May 2020. 1st May 2020. Okay. So 1st May 2020. 1st May 2020. 1st May 2020. What is happening on 1st May 2020? What is happening on 1st May 2020? First, ZX Limited. ZX Limited should go and take a 60,000 rupees loan from the banker. ZX Limited has to take 60,000 loan rupees from the banker. Okay, and ZX Limited has to pay that rupees 60,000 in the spot market. Rupees 60,000 in the spot market, and they have to obtain $800, and they have to obtain $800, and they have to obtain $800. Next, ZX Limited has to pay that $800 to the authorized person and FEMA, authorized person and under FEMA, authorized person and FEMA, and they will enter a forward contract, and they will give a forward contract. So this is what will happen on 1st May 2020. This is what will happen. Okay, 3 steps on 1st May 2020. These are the 3 steps. Step 1, borrow 60,000 loan. Step 2, pay that 60,000 loan and obtain $800. Step 3, pay $800 and I enter into a forward contract. So these are step 1, step 2, and step 3. So this is how the transactions will happen today. 1st May 2020. Next, what happens on 1st November 2020? What happens on 1st November 2020? What happens on 1st November 2020? Right. So on 1st November 2020, we have to go and borrow money. Okay. Right. So on 1st November 2020, what will happen? Right. ZX Limited has to pay. ZX Limited has to pay how much it is? 80,000 into 74, it is 59 lakhs 20,000. 80,000 into 74, 59 lakhs 20,000. ZX Limited has to pay 59 lakhs 20,000 rupees to the authorized person under FEMA. So thereafter, he will receive the $80,000. He will receive the $80,000 inflow. This $80,000 will be inflow. Right, fine. That is one contract. Next another point is that. As usual, ZX Limited will pay that $80,000. Will pay the $80,000 to foreign supplier, foreign US supplier. This is our business transaction done. And what is left over? Is this loan amount, whatever we have amount borrowed to repay the premium. So this is pending now. Now this is pending. So we have to repay that. Along with interest, we have to repay. What is the interest for that 60,000? The interest for that 60,000 is, look at this. The interest for 60,000. Okay. The interest for 60,000, how much is that? The cost of funds is 10% per annum. 10% per annum. How many months? 1st May 2020, we are entering into a contract, and the contract is expiring on 1st November. So 1st May means June, July, August, September, October, November. 6 months. October, November, 6 months. Okay. Right. Now, so therefore, on November for 6 months, ZX Limited has to repay the loan along with the interest. ZX Limited has to repay the loan along with the interest. So ZX Limited has to pay to the banker how much? 60,000 loan plus 60,000 loan into 10 by 100 rate of interest into 6 by 12. So that will be 3,000. Total rupees 63,000 we have to pay. Total 63,000. So 10% is per annum. 6 months, 5%. So 60,000 into 5%, 3,000. 6 5 is 30. 6 5 is 30. 60,000 into 5%, 3,000. Or you can take 10% is 6,000. That is per annum interest. Half yearly interest, 3,000. Okay. Right. This is what the point. So therefore, if you look at this point, this is knocked off. inflow of dollars, outflow of dollars. This is knocked off. This is knocked off. Therefore, what is remaining is only this point. 59 lakhs 20,000 and this 63,000. 59 lakh 23,000 and 60. So 59 plus 60, 59 lakhs 83,000. 59 lakhs 83,000. So therefore, total cost of forward. Therefore, total cost of forward. Therefore, total cost of forwards is 59 lakhs. 59 lakhs 83,000. Total cost of forward is rupees 59 lakhs 83,000. That is what we'll write. Okay, right. So therefore, if we'll write the first point, cost of premium. Okay, premium cost along with the interest. Okay, first point, premium, forward premium along with the interest. Forward premium along with the interest. Forward premium along with the interest. How much? Forward premium along with the interest is how much? 63,000. Forward premium along with the interest 63,000. Okay, that is what our answer. Forward premium along with the interest, it will be 63,000. Okay, it will be 63,000. So how you got that 63,000? A point. Premium will be how we got that premium? We have to write that $80,000 into 1% into 1% bracket close into rupees 74 into rupees 74. Okay, right. Into rupees 74. This is how we got the premium. This is how we got the premium. Okay, so this will be how much? It will be 60,000. That is what we have written above. That is what we have written above. It will be 60,000. Okay, right. So it will be $80,000 into $80,000 into 1% into 74. $80,000 into 1% into 74. 59,200. Next, cost of borrowed funds. Cost of borrowed funds. Okay, interest cost on premium. Okay, cost of funds on premium. Cost of funds on premium. Cost of funds on premium amount. How we got that cost of funds on premium amount? Same. Sorry, 80,000 into 1 into 75. Sorry, this is 75, right? Spot rate 75. So this will be 75. Okay, right. So 60,000 is the dollar. So cost of funds on premium, rupees 60,000 into 10 by 100 into 6 by 12. 10 by 100 into 6 by 12. Cost of funds on premium. Okay, that is what we'll write. So 60,000 into 10 by 100 into 6 by 12 into 6 by 12. I'll get the premium amount of 3,000. I'll get the premium amount of 3,000. Okay, right. So 63,000. Okay, the total will be 63,000. The total will be 63,000. Okay, next what with the interest. Now B point. So what is the B point? Okay, next for cost of purchase. What is the cost of purchase? $80,000 into simple. So $80,000 into agreed upon rate of rupees 74. Into agreed upon rate of rupees 74. $80,000 into agreed upon rate of 74. Into agreed upon rate of 74. 59 lakhs 20,000. 59 lakhs 20,000. Okay, 59 lakhs 20,000. Therefore, the net cost will be this point. The net cost will be 59 lakhs 83,000. Okay, so expect payments with hedging. Payments with hedging. Okay, payments with hedging under forward contract. Payments with the forward hedging. Payments with the forward hedging. Payments with forward hedging. This is our working note 1. So this will be our working note 1. This will be our working note 1. Okay, ma? So this will be our working note 1. Payments with hedging. Payments with hedging. In our framework, whatever I have seen, first we have to look at the payments with hedging and then payments without hedging. Payments with hedging and then we'll look out the payments without hedging. Payments with hedging. Right. So payments with hedging, 59 lakhs 83,000 is the payment without hedging. With hedging. Next, payments without hedging. Payments without hedging. So how will you draw the payments without hedging? Okay, right. So these are all about the premiums. For premium amount and forward amount calculations. That mistake we have to avoid, that 1% is to be applied on the amount purchased, not on the amount paid. So the company can hedge its position with the following expected rate of USD in foreign exchange market on 1st May 2020. According to me, there is a drafting error. It should not be drafted in this manner. This is not the correct way of sentence formation. This is not the correct way of sentence formation. Okay, let me explain what should be the sentence formation there. The appropriate sentence formation will be the company expects the following rates. Two errors are here. The company is not that the company hedges with the expected rate. When you are doing, there is no question of expected, it's fixed. When we are doing hedging, there is no question of expected, there is fixed. The company can hedge its position with following expected rate. Hedge expected is contrary words. You should not use this. Hedge expected is the contrary words. Hedge means fixed. There is no uncertainty. Expected means uncertainty is false. Our expectation may come true. Our expectation may come false. Therefore, expectations involve risk. That is without hedging. The moment you are using the word called as hedging, there is no question of using the word called as expected. Expected is an uncertainty. So therefore, that is not the correct word to be used. Both are apparently opposite. Okay. Hedge. The company expects the following rates. The company expects the following rates to prevail, and this is also already we are in 1st May. And they have given the exchange rate. This should be November 1st. This should be 1st November. Already we are in 1st May. Therefore, there is no question of predicting the exchange rates on 1st May. We are already in 1st May. Therefore, that should be 1st November. Therefore, the company expects the following rates to prevail on 1st November 2020. On 1st November 2000, something like this. Okay, so this should be the on 1st November. The company expects the following rates to prevail on 1st November 2020. This should be the correct sentence formation. But that sentence formation has to be corrected. According to me, that sentence formation is an error, drafting error, because there is no question of hedging and there is no question of expectation. There is no question of expectation. The hedging, the question should be like this. That portion of the question should be redrafted. The company can hedge its position now. The company expects the following rates to prevail on 1st November 2020. This should be the question actually, right? So therefore, this is the expected rates to prevail. Different rates has been prevailed. Okay, right? Look at this. So for the examination solving, it's fine. Even for your knowledge sake, also you should think about the sense how this forward probabilities does make sense. Whether these probabilities make sense or not. Whether these probabilities make sense or not. Yes, these probabilities will make sense. How? If you look at this point, forward rate may not exactly predict the future spot rate, but to great extent, forward contracts will predict the direction. They may not predict the exact distance. Okay, forward contracts, for the rate of forward contracts better indicates that to a great extent indicates the direction, may not be the distance. Okay, so forward rate provides an indication as to future direction of direction of movement in exchange rate in exchange rate. Okay, direction of movement, not the distance of movement. Forward rate provides an indication as to direction of movement in exchange rate, though they may not predict exact distance. Okay, distance they may not predict, but direction they can provide the hint. Distance and direction both are important. Okay, so direction versus distance. So forward contracts provides a hint about direction, but not about the distance. That means if you look at the question, the spot rate is 75. The spot rate is 75 and the forward rate is 74. The spot rate is 75 and the forward rate is 74. That means the forward rate is less than the spot rate. The forward rate is quoting at a discount. That means there is more chances of forward rate falling rather than rising. Okay, how much fall maybe depends upon the actual supply and demand conditions, depends upon the actual confidence in the economy, but definitely there is a more chances of decreasing rather than increasing. That should be clear. Forward rate indicates that there should be more chances of decreasing rather than increasing. So based on this direction, we have to evaluate whether these probabilities are sensible or not, whether these probabilities make sense or not. If you look at these probabilities, out of this less than 75, the present rate is 75. Less than 75 is these two rates. These two rates are less than 75. These two rates together make up 65% probability. These two rates together make up 65% probability. Therefore, there is more chances of falling the forward rates rather than rising, which is already indicated by the banker. So banker has already done his analysis. So the banker also predicts that the forward rate will fall. And this probability analysis we have to do in-house. This probability analysis we have to do in-house. Based on that, we have to take a decision whether to go for the hedge or not. Okay, so we have to ensure that our in-house probability analysis, whether that probability weights, whether that makes sense or not, depends upon the forward rate. Okay, by comparing these two, yes, our in-house department has provided these probabilities, and out of that, if you look at this point, there is more chances of forward rate falling from 75 rather than increasing. There is only 35% chances that forward rate may increase, but there is 65% chances that the currency rate may fall, which is what the banker is also predicting. When the current spot rate is 75 and the banker is willing to sell you at only 74, that means banker is definitely predicting that the forward rates will fall. That is what even hinted by our in-house department also. So therefore both are consistent. Accordingly, I can go ahead with this. Okay, right. This is what the point. Right. So that is how we have to evaluate whether the forward rates make sense or not. And one more point: why these forward rates are falling? Why these forward rates are falling? It's very clear. If you look at beyond the exam problem solving the exam, if you look at why the forward rates are falling, two reasons. First reason, because of uncertainty in the US elections. We are seeing the 1st May and 1st November. So because before 1st November elections has not yet completed, there is an uncertainty involved in the US elections. First point, and the second point is US is the country which is most affected by the pandemic. US is the country in the world. US is the top country which is being most affected by the pandemic. So because of these two most important reasons, there is more chances that the US economy may fall, the US economy may go in deep trouble rather than rising. Okay, because of these reasons, we are predicting that it is less than, forward rate is less than the spot rate. I'm just explaining the reason on what basis the banker is predicting that the forward rates will fall. Even in our in-house department also predicting that the forward rates will fall. The economic reason for prediction fall of forward rates is, first one is US elections uncertainty. Another one is US is being most hit by the pandemic. So because of these two reasons, that is consistent. So therefore, we should be thorough with our probability statistical data and the real economic data. Okay, so without economic knowledge, without real world knowledge, statistics does not make any sense. Statistics may throw wrong figure if you don't have the underlying economic knowledge. Okay, right. This is what the point. So that is the reason for this probability. Anyway, so that is not necessary for the exam. In exam, if it is sufficient if you simply do multiplication. But just for your knowledge sake, I am giving. Right. Now look at this expected rate. So expected rate is this point. What is the expected rate? Expected rate is 4 expected rates: 77, 71, 79, 74. 71, 79, 74. Okay, right. This is the expected rates. Expected rates and payments, probabilities of payments. Okay, payments. Expected rate, expected payments. Okay, expected rate, expected payments. 80,000 into this point, $80,000 into this point. Okay, so how we got the expected payments? How we got the expected payments? $80,000 into $80,000 into expected rate. Okay, $80,000 into expected rate. Okay, this is what the point. $80,000 into expected rate. Okay, right. Same thing. This is the expected rate. And probability, I'll explain here. The way you are present the answer in the examination is different, and the way the answer has to be presented in your corporate life is different. First, I'm writing the presentation as per the examination. What the most students will done, if not this one. What the most students will done, I'll show you. What is done by most of the students in the examination, I'll show you. Okay. So this is the presentation that may be acceptable in the exam, but in corporate life, that is not the acceptable way of presentation. I'll show you a different way of presentation. So probabilities, how much is the probabilities? 0.15, 0.15. Next. 0.15, another one is 0.25, and 0.20 and 0.40. These are the probabilities. 0.20, these are the probabilities. Okay, right. So probabilities and the probability weighted expected rate, probability weighted exchange rate. This is what the most of the students will done in the exam. Okay, that is sufficient. That is fine for the exam, but that is not the way you have to done in the real corporate life. 74.70, 74.70. They will write it as an expected rate. Expected rate 74. The expected rate $74,000. Okay, right. So probability weighted expected rate is 74.70, 74.70. Okay, right. Now, so after 74.70, we'll write the working note 2. What is working note 2? Payments under payments with hedging. Working note 2, payments with hedging. Working note 2, payments with hedging. Working note 2, payments with hedging. Okay, right. Right. So you have to clearly write the word expected, not the fixed. Expected payments without hedging. Expected payments without hedging. What is the expected payments without hedging? $80,000. $80,000 into rupees 74.70. $80,000 into rupees 74.70. So this is how the most of the students will present in the exam. 59 lakhs 76,000. 59 lakhs 76,000. This is the expected payments. This is the expected payments. 59 lakhs 76,000. Then what is our answer? Working note 1, payments with hedging is 59 lakhs 83,000. Payments without hedging is 59 lakhs 60,000. Payments without hedging is 59 lakhs 76,000. Then what is our answer? Our answer should be what is our framework we have written? Based on the what is the framework we have written? Payments with hedging. What payments with hedging is? What is the payments with hedging? 59 lakhs. How much? 59 lakhs 76,000. 59 lakhs 76,000. 59 lakhs 83,000. Payments with hedging is 59 lakhs 83,000, and payments without hedging is 59 lakhs 76,000. 59 lakhs 76,000. So therefore, this equation is not satisfied. This equation is satisfied. 59 lakhs 83,000 is more than 59 lakhs 76,000. Therefore, hedging is not preferable. Therefore, hedging is not preferable. This equation is satisfied. The above equation is not satisfied. Therefore, this equation is satisfied. So therefore, here you have to write this point. Okay. As the expected payments, or if you write clearly, this is our advice. Okay, this is our advice. This is our advice. Okay, this is our advice. What is our advice? As the expected payments without hedging of rupees 59 lakhs 76,000 of rupees 59 lakhs 76,000 is more than the payments, is less than the payments with hedging, is less than the payments with hedging of rupees 59 lakhs 83,000 of rupees 59 lakhs 83,000. It is advisable not to hedge the risk, not to cover the risk, not to cover or hedge the risk, not to hedge the risk. This is what the point. Okay, this is the answer we'll write. But here, this answer is appropriate for what kind of corporates? This answer is appropriate for a corporates who are risk neutral. This answer is appropriate for the corporates which are risk neutral. What is meant by risk neutral? Neither they are scared of the risk, nor they love the risk. Okay, there are three types of corporates or three types of investors. One is risk averse investors, and risk neutral, and risk lover. Three types of investors. Risk neutral and risk lover, three types of investors. This risk averse investors, they will avoid the risk. They don't want to bear the risk. This risk neutral investors, if they get benefit, they will take the risk. If they don't get benefit, they will not take the risk. So in the given case, if you take the risk, we'll get the benefit. What is the benefit if we take the risk? Because our cost will be saved 59 lakh 83,000 to 76,000. That means approximately we can save 4 plus 3, 7,000 will save the cost. So if you without hedging means taking a risk. Without hedging means taking a risk. So if because of taking a risk, you will save the cost of 7,000. So by looking at that benefit, they are ready to take the risk. Because the benefit is offered, they are ready to take the risk. So therefore, for the risk neutral investor, this is the appropriate advice. For risk neutral investor, this is the appropriate advice. Okay. So if the company is a risk neutral entity, it can avoid the hedge and can bear the risk with the expectation of 7,000 cost savings. Okay. If the company, if ZX Limited is a risk neutral, if ZX Limited is risk neutral, it can avoid the hedging. It can avoid the hedge and bear the risk with an expectation of bear the risk for the expected cost savings of rupees 7,000 Okay, this is what the point of rupees 7,000 for the expected. If the ZX Limited is risk neutral. On the other hand, if the ZX Limited is risk averse means what? They don't want to bear the risk. They are very scared about the risk. They are ready to sacrifice their profits for the sake of avoiding the risk. They don't want to bear the risk. They are ready to sacrifice their profits for avoiding the risk. So if ZX Limited is risk averse, it is advisable to hedge the risk. It is advisable to hedge the risk with forward contract. Why hedge the risk? Because they are risk averse. That means they don't want to take the risk. They are ready to sacrifice the profits. If you look at this point, 59,83,000 minus 59,83,000 minus 59,76,000. So 7,000. What is 7,000 out of this 59,83,000? If you look at this 7,000 out of this 59,83,000, it will be how much it is percentage. If you look at this very small percentage, 0.12%. That means our cost will be increased by 0.12%. That's it. If you want peace of mind, if you don't want to take the risk, you want peace of mind, right? In that case, you can go for the forward contract. Let the cost be exceeded. Hardly 0.12% cost is exceeded, but you are risk averse. You are ready to sacrifice this much of profits. We are ready to sacrifice this much of profits with a view to avoid the risk. So therefore, our advice for the examination, unconsciously, students are giving this advice. For the examination, unconsciously, students are giving this advice without thinking that advice is suitable for the risk neutral investors. But most of our fundamental assumptions, perfect market, perfect competition assumptions are based on risk averse investor. Therefore, we have to give this alternative advice also. Okay, that is what the point. If ZX Limited is risk averse, it is advisable to hedge the risk with forward contract. Right, both the answer. My suggestion is write both the answers so that you will get little bit more impression the paper value. Okay, so if it is a new risk neutral, they will take the risk, avoid the hedging, take the risk for the profit. Risk neutral. That means what? If I get the benefit, I'll take the risk. If I don't want to get benefit, I don't want to take the risk. I am neutral. Neither I love the risk, nor I hate the risk. Risk averse investors will hate the risk. Risk neutral investors will neither love the risk nor hate the risk. Something benefit comes, they will take the risk. Otherwise, they will not take the risk. Risk averse investors, they will hate the risk. Therefore, they are ready to sacrifice their profits for the sake of avoiding the risk. So therefore, our advice is suitable for the risk neutral investors. Accordingly, my suggestion is that write both in the exam. For risk neutral investors, it is advisable not to hedge. For risk averse investors, it is advisable to hedge the risk. Okay, that is what the point. That is one thing. So in the examination, you can write this answer. But in the corporate, I'll show you the presentation, how to make this presentation in the corporate. It is not the way, this is not the correct way of presenting. It may be easy for you to present in this way, but that is not the correct way of presenting. I'll show you the correct way of presenting. Okay. First point is expected payments. First, you have to write this point. Expected payments without hedging. Expected rate. First, you'll write this expected rate. This is what you have to present in your corporate life. I'll show you that point. Expected rate and expected payments without hedging. 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 Next, thereafter forward payments with hedging. Payments with hedging. So what is the payments with hedging? Same our working note. What is 59,83,000? 59,83,000 is our payments. Okay, 59,83,000 is our payments. 59,83,000 is our payments. Sorry. This is 50,000, 59 lakhs 83,000. Next, now we have to think about savings, cost savings due to hedging, cost savings due to hedging, cost savings due to hedging. This is what you have to write. This is what you have to cost savings due to hedging. If you look at this point, this payments is more and this payments is less. Cost savings due to hedging is 1,77,000. If I write like this is what we'll get. Okay, cost savings due to hedging. Now, next point, what is the probability of this savings? Probability of this savings, probability of this savings. What is the probability of this savings? Now we have to copy that probability. Now we have to copy that probabilities. Probability of savings, probability of savings. Okay, right. Probability of savings. Therefore, expected savings, expected savings, expected savings. Probability weighted savings, probability weighted savings, probability weighted savings. Okay, probability weighted savings. You have to write this point. Okay, right. Why I got negative? 77, 71, 79, 74, 59,83,000. Cost savings, we got the negative with hedging. Sorry, without hedging. Okay, this is what the point. Okay, payments with hedging. The next benefits with the hedging is 7,000. Therefore, as the next expected benefits are negative, it is not advisable to hedge. Okay, expected benefits due to hedging. Expected benefits due to hedging. Expected benefits due to hedging. As the expected benefits due to hedging is 7,000, it is not advised negative. The 7,000 is negative because if you go for the hedging, we'll get a loss of 7,000. 7,000 is the expected loss of hedging. Since the expected figure is a loss, we'll not go for the hedging. Since the expected figure is a loss, we'll not go for the hedging. This is a negative way of presenting. This is a negative way of presenting. Or you can present in a positive way also. Or you can present in a positive way also. Look at this point. Cost savings due to with cost savings due to not hedging. You can write like this also. This is a positive way of presenting. Cost savings due to not hedging. In that case, we have to give this formula. Cost savings due to not hedging. Okay. Cost savings due to not hedging. Now we'll get the 7,000 positive. 7,000 positive. What are the cost savings due to not hedging? Look at this. With the hedging, we got this payment. Without hedging, we got this payment. Therefore, we got the excess amount. We got here, we got the excess amount. Here, we got the less amount. 7,000. 7,000. As the expected benefits for due to not hedging, expected benefits due to not hedging is rupees 7,000. 7,000. 7,000. Therefore, if you make the present, if you give an advice to your CFO saying that, sir, it is not advisable to hedge, he will ask, okay, if I follow this advice, what is the benefit I'll get? If I follow your advice, what is the benefit I'll get? You have to write the 7,000 points. Okay, sir, if you follow my advice, there is a chance of you are getting 7,000 more profit or 7,000 less cost. So this is how we have to present. We should not take 71. What does it make sense? 77 into 0.15, 11.55 rupees. What figure that? What does this figure make sense? No, every figure in our answers does make some sense. What is the what is called what can you speak about this 11.55? If somebody asks you what is the 11.55, I can't say anything. What is that 11.5? Therefore, it may not be. It is maybe easy way of presenting in the exam, but that is not the correct way of presenting in the answer. Okay, so we have to think about different scenarios. We have to think about different scenarios. So this scenario may happen, this scenario may happen, and this scenario happen. At the worst case, you may lose 67,000 also. At the worst case, you may lose 67,000 also. If you don't go for hedging, at the worst case, you may lose 67,000 also. That is the risk. If you are ready to bear that much of risk, that should be your value at risk. If you are ready to bear that much of risk, then go and avoid the risk. Therefore, these are all the figures, worst case figures and two best case figures. This will not be indicated if you follow this point. If you follow this point. Therefore, according to me, these figures does not make any sense. These figures does not make any sense. Maybe for the examination purpose, you may get the same answer. You may get the same answer of 7,000 even if by doing this probability weighted 74.75. But that is not the corporate way of presenting the answer. Accordingly, my advice is that in the examination, maybe to save the time, present like this. But in real life, in your corporate career, don't present in that manner. That 11.55, 17.75 does not make any sense. Every figure you use in the answer, you should be able to explain what does that figure stands for. If I ask you what is this 17.75, what is the stands, you can't explain it. Therefore, it is not advisable to use those figures. Okay, ma? This is the way you have to present. Okay, right. So anyway, so this is the first problem, and ultimately the conclusion is that risk neutral investors and hedging is not advisable. Risk averse investors, hedging is advisable. And moreover, this last sentence is also not correct. You are required to advise the company so for a suitable cover of risk. This should not be the sentence. Actually, the proper sentence formation should be different. Okay, that is not the way of present. That is not the correct answer. They're asking for suitable cover. That means which hedging strategy to be used. Suitable cover. Suitable cover means you have to have some choices, forwards, futures, and options. But then in that case, I can pick up which is suitable cover. Here, the given is only one thing, whether to cover or not which is suitable cover. The information is given is whether to cover or not. But the question is asking is which is suitable cover. Therefore, that is not the correct sentence. You are required to advise. According to me, the correct sentence would be, this point. According to me, that's a correct sentence would be, you are required to advise whether to cover the risk or not. This should be the correct sentence of the question. Okay, right. That sentence, you are required to advise the company. You are required to advise the company for whether to cover the. You are required to advise the company as to whether it should cover the risk, whether it should cover the risk or not. Cover the risk. This is the sentence. Suitable cover means they are asking which hedging strategy. They have given only one hedging strategy. Where is the question of picking which is the suitable hedging strategy? The question should be whether to hedge or not which hedging strategy to be used. Therefore, these are the drafting errors in the question. So ultimately, this is the point. The first point you have to remember is that what is the reason for the forward premium and the possible mistake in the exam, how to calculate the premium. I have shown you this is the wrong calculations done by some of the students. This is a 59,000, is not the point. This is the money paid and this is the amount purchased. This is the money paid and this is the amount purchased. We have to go based on the amount purchased, not on the money paid. 1% is applied on the amount purchased, not 1% should not be applied on the amount money paid. So therefore, this is the one area you have to avoid the mistake. And another area we should not forget this interest rate 10% that is given per annum, and the contract duration is 6 months. That you should not forget. Some students may directly take 6,000 here. That is also possible mistake. Two possible mistakes here. And this later on you'll give that advice. And in order to get more marks, right? Be clear for what kind of investors, what is that advice. It is not that every investor don't want to take the risk. It is not that every investor want to take the risk. Based on the client risk perception, we have to give that advice. Okay, right? So in the next video, we'll come out with a 1B problem. So I'll be giving the solutions to entire question paper, November 20 paper. This is the first problem, go through it. In the next video, I'll come out with the second 1B. Okay.